Goes on a 3.6 billion stock selling spree, raising eyebrows. Anytime someone has like a massive amount of a stock position, sells massive amounts of them, it does raise eyebrows because people are like, whoa, okay, what the hell's going on? So Ernie Garcia, too, the billionaire father of used car dealerships Carvana's CEO, has sold more than $3.6 billion of company stock since October, raising eyebrows over whether the ownership structure of the firm gives the family too much control. The only people who have sold more stock than Garcia, too, since the start of 2020 are Amazon founder Jeff Bezos and Facebook founder Mark Zuckerberg and members of Walmart's Walton family, the Wall Street Journal reported. But while those companies have long been massively profitable, Carvana just recently posted its first quarterly profit of $45 million this spring, according to filings with the Securities and Exchange Commission. So just imagine, right, that you sold over $3.6 billion of company stock in a company that just had $45 million in profit. Like, that's so absurd. So Carvana stock tanked at the start of the pandemic, and both Garcia too and his son quickly scooped out $25 million worth of stock, each in a private offering below the market price at $45 per share. So shares quickly rebounded as the company's e-commerce platform for used cars saw huge demand during the pandemic, and the stock doubled less than 2 months after the sale and continued to soar. So disgruntled shareholders then sued the father-son duo, accusing them of insider trading and using the pandemic as an excuse to buy shares at bargain basement prices, even though they knew Carvana had a strong balance sheet. So the existing structure has allowed them to run this $60 billion public company as if it's a family firm. And for the family's benefit, Daniel Taylor, a professor of accounting at the Wharton School, told the Journal, "It's amazing. Garcia 2 and his son, Ernie Garcia 3, control more than 85% of the company's voting power because of a structure that makes share held by the Garcias count for 10 votes compared with those available to the public," the Journal reported, adding that their stock is worth more than $23 billion. So Garcia 2's ownership of the company is so big that his $3.6 billion in recent sales only account for 16% of his ownership. Now that is crazy. So the interests of the Garcia parties may not in all cases be aligned with their stockholders' interest, the company even warns in the annual report to the SEC. In addition, the Garcia parties may have an interest in pursuing acquisitions, divestitures, and other transactions that in their judgment could enhance their investment, even though such transactions might involve risks. So Garcia's 2's $3.6 billion stock selling spree in October, after shares of the company spiked fourfold to more than $200 per share from March to September 2020. So his stock sales were part of a June 10BF-1, which is a predetermined selling plan that lets insiders avoid the appearance of illegal trading. But he modified the plan in November, according to the Journal, and then again in May as the company's stock price continued to soar. "I've studied 20,000 10B5-1 plans," Taylor told the Journal. "I can't recall another of this size where there are modifications every 6 months." Now, to me, I don't think the issue is just the modifications. I just think their structure is so interesting and so highly leveraged in keeping them with control and power over the company that they're running, basically. So it's not the first time that Elder Garcia has found himself on the wrong side of the law. In 1990, he pleaded guilty of bank fraud for his role in Charles Keating's Lincoln Savings and Loan Associations, a shady savings and loan bank. So Carvana representatives did not return the Post's request for comment, and a spokeswoman told the Journal that the company has robust governance and operates in accordance with all rules and regulations. She also noted the company has delivered more than 2,000% returns to its investors since its public offering. Now, I'm not hating on Carvana, the company. I think it's a great idea. I see a lot of Carvana trucks actually delivering Carvana vehicles, right? So there are people literally using their product, right? The thing that's interesting, right? And I don't necessarily think this is a bad thing, because like, let's put it this way, right? Let's say that you were to create a business, right? And you wanted the future of that business to align with what you plan on that company actually being, right? Like, let's say that you create a business that is focused on creating the best energy drink in the world, right? Like, that is your goal, right? But you make it public, meaning people could start investing into it. You have a board, right? But you still want to have that same like game plan of creating the best energy drink in the world. And you don't necessarily want people to sway that into potentially going like, oh, I want to make the best orange juice drink, or I want to make the best vegan drink, or I want to make the best vegetarian drink, or I want to make a drink that's like filled with like meat juice or something, right? So you structured the deal and how you go public and have shares represented to the public in a way that pretty much you could structure it to where you always have control as to the path that the company takes, right? So I think that's honestly a good idea if you are very connected to basically the success of the company, or that you first created the company or that kind of stuff, right? So I don't think there's necessarily a wrong thing for them structuring their deal or having structured their deal in this type of way, right? I just think it's odd for them to be selling so much of their stock, because the way to view that, if you are an investor in the company, is like, okay, why is basically the larger shareholders of this company selling their shares, right? Is there something wrong with the company that we do not know? What is going on here? Because this is not a small amount of money, right? This is a large amount of money. And this is a large amount of money in a company that's not necessarily making a lot of money, right? Just think about that, right? They basically sold crazy amounts more than what the company actually made in profit. Like, this is basically the equivalent, pretty much, of, a shareholder of Apple, like a massive shareholder of Apple, ending up basically selling hundreds of billions of dollars. Actually, it should be actually more like, I think, like $1 trillion. Let's say this one, like, we're to sell like $1 trillion of Apple stock, right? When the company's only made like a couple hundred billion in profit, blah, blah, blah kind of stuff, right? Like, it's just really weird, right? Like, the optics is weird. It's very sketchy, to be frank, but the structure is something that I don't really view as wrong, right? I think it's actually smart if you want to have control, or like keep control as to the path you want the company to actually take, right? I don't think there's anything wrong with that. It's just shady when someone who owns a massive amount of the company's stock ends up selling a large amount of money, because it's like, think about it, right? Like, what are you going to do with $3.6 billion, right? Like, really, what are you going to do with that, right? Are you going to just make the company better? No. Are you going to just like sell all this stuff so that you could buy a bunch of yachts? Like, what's going on here? Like, why did you sell all these stock for billions and billions of dollars? Like, what was the purpose of it? Was it just to make a lot of money quickly, right? So it's just something to really think about. It's like, oh, what could really end up happening, right? But either way, if you want to learn how to get out of debt and manage your money so that you're not really tempted to get into like companies like these that potentially the owners or main shareholders don't necessarily align with your views, you should learn how to master your money, or at the very least get out of debt, so it doesn't really matter necessarily what you really do.